Okay, Tyler. So we've done a follow-up video on NextEra Energy Partners. We also talked about NextEra Energy as well, right? This forever stock and concerns about the change in the interest rate environment and that affecting its ability, its capital allocation plans. And so far, we found out that you were exactly right with this concern. The stock is down more than 20%, I believe, since they rolled out their new capital plan, especially for NextEra Energy Partners. As a result, we have some line of sight into what the company's plans are. The stock price has come down a bunch and it's pushed the dividend yield over 3.5%, which is putting it in the range of where we've seen a lot of utilities over the past decade. Plus, NextEra Energy still has Florida Power and Light, the great demographics of Florida, those tailwinds of population growth and economic growth that should allow it to continue growing its core business. The question I have for you, Tyler, are you ready to have a conversation about whether or not NextEra Energy is a buy or not? And if it's not, maybe an alternative for investors to consider.
I am absolutely ready to have. Let's
Let's
go.
do it. Let's do it. Before we do, though, just a reminder, the Motley Fool sponsors our videos. If you're looking for even more great stock ideas, please go to our special link, fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that out after this video. Again, the short version of everything that's happened. First of all, NextEra Energy stock's down more than 40% from its high over the past 52 weeks. So it's not just
Don't
what's
see that
happened.
much in utilities, do you?
You really don't, Sweet. The market's been maybe expecting something like this for a while. This is a utility that's typically traded for a much higher multiple. We've talked about that in other videos. For good reason, though, because its growth story has been incredible between Florida Power and Light, the demographics of Florida that have been so good for it, population growth, economic growth, all of those things have been great for NextEra Energy, but also it's non-regulated power side, right? Primarily a lot of renewable energy where it's invested billions of dollars to grow its renewable energy production and then selling that power into the unregulated market, right? To other utilities that need more power or they want to start replacing hydrocarbons with renewables, right? For various reasons. And it's been an incredible growth story for really 20 years or so. Over the past year, rising interest rates have created an headwind for the company because of cost of capital, right? Because we know utilities are more limited in what they can, their profit margins that they can earn because they have regulations about how much they can charge, how much they can profit. And then on the unregulated side, this is the thing we really learned the most over the past week was that cost of capital is just making it too expensive for NextEra Energy to be as aggressive with its growth as it has been. What else am I missing for what's changed with the story with NextEra Energy?
I want to dive a little bit deeper into a point that you made about the regulated utility, because this is why for decades people have appreciated and want to go after utilities is because they're regulated. And in a rising interest rate environment, that is actually beneficial to a utility. When a regulated utility wants to make investments, it has to get those investments approved by a regulator. That's why it's called a regulated utility. Now, typically, regulated utilities are done in a way so that when a state regulator approves a project, it means that project is approved for a set return on equity with a set capital structure, and they are allowed to price their electricity or their service accordingly such that it hits those returns at that capital structure. That's pretty much how regulated utility pricing works, right? So in a rising interest rate environment where your cost of debt is higher, you are able to pass that on in your electric bills to its customers because you are more or less, you're capped at a certain return on equity. I've seen a lot of state utility regulators somewhere around like returns on equity of about 9%. Okay. So basically they can get returns up to that level, and most of them are pretty good at getting maximum returns. I'm not really concerned about the regulated side of NextEra Energy Partners in the slightest, or a lot of other utilities really. Like, they're still going to be able to do that. And I think there is the appetite from regulators, mostly across the board, for either some component of grid resilience or trying to expand for the electrification of everything, a topic we've talked about a lot about on other videos with EVs and everything else using electricity instead of fossil fuels, and then also just deploying renewable power assets within that regulated framework. So with all of that spending, yeah, I'm not too worried about the regulated side. I think the regulated side more or less is going to be able to take care of itself rather well. And as I don't think you're going to see a lot of compromise in that side of the business. Now, it's where the unregulated side where things get a little dicey because let's say for the past 10 years, I have been signing pricing power contracts to either businesses or other utilities where these are just market price contracts, right? Typically, they're done over long periods and they'll have some sort of inflationary component tied to them, but a lot of them didn't really plan on 3, 4, 5% inflation rates when they did these. They were typically, they'll cap out at 3 or something like that. And so when you have that, just to be clear, I'm not specifically saying that NextEra Energy's pricing contracts are capped out at 3. Please don't aggregate that. It's a
Understanding of how the
broad stroke
industry is
understanding.
structured. Right, right.
Yes. So when you have that in
This
place,
carries over. This isn't just for the utilities. This also affects like solar panel installers who have long-term contracts with residential customers or commercial
yep,
customers
yep,
where they have those annual escalators that have certainly been lower than inflation over the past couple of years, right? So
yep,
it's a broad concern for the industry with long-term contracts on these
right.
kind of assets.
So on the regulated side, I could definitely see a significant slowing down of business, some eroding of profitability a little bit, and
On the
that could
unregulated
be
side, I mean.
on the unregulated side of the business. So I could see issues there. I could see slowing down of dividend growth levels. And we talked about NextEra Energy Partners slowing its distribution growth. If that source of cash for the parent is slowing down, that probably subsequently means that we're going to see a slowing of dividend growth in NextEra Energy Partners. So regulated's okay, but it's not going to grow fast for all the reasons I just mentioned. Unregulated, it's probably not going to do great. And then a slowing component from NextEra Energy Partners, you kind of dice that all together. And I say, I see a situation of NextEra Energy having a much slower dividend growth than we have seen historically from them, which has been in the 8 to 10% range. And so, again, we've talked about like yield versus growth back when it was 10 to 12% dividend growth and they were paying out a 2% dividend. That's pretty good, right? But now, let's say we cut that in half to 5 to 6, all of a sudden I'm not getting a great return with that low yield. Hence the rapid decline in price. And today, NextEra Energy's dividend yield,
Right at 3.6%, which is not bad, but it's certainly
not
not
bad,
a high yield, right? In this
right?
environment, maybe it's a high yield against other stocks, but against other stable assets, right? Fixed
And
income, the 10-year
that's
treasury is
the
close to
difference.
5% at this point.
Yes. And Jason, we are in a different interest rate environment. We are in a
Right.
different investing environment. You need to adjust your investing strategies accordingly. And so if I know that NextEra Energy right now with a 3.5% yield and a slowing dividend growth, it's look like the business components look like they're going to be slowing. There is part of me that says that at this price, it's not adequately priced in. If, like you said, if I can get a US Treasury bond at almost 5% versus a 3.5% dividend yield, that's not attractive. That's not a premium for taking on the risk of equity, which just dropped 40%. And that's why it is. This is the at-risk portion of the capital of the company. It rises and falls like this. And that's why we're compensated. I don't think that we are adequately compensated for that risk at the current dividend yield.
I'm gonna push back a little bit because the stock now trades for 12 times, 12 and a half times earnings, which is I think fair value for a regulated utility that has some ability to grow probably faster than the majority of utilities, faster than inflation, right? Faster than GDP growth, which makes it more valuable than owning a 10-year treasury at 4.5 to 5% over a 10-year period. It should certainly outperform that at this valuation. And I think if that's the thing, if you're looking for more wealth creation than just trying to preserve your capital, and 3.6%, 3.5% yield on your dollars today is an adequate level of dividend for income needs or whatever you're looking for. And then you can also count on some growth in value, some wealth creation, I think it's reasonable right now with one caveat. And we've talked about it already, but that one caveat is, can the income that it derives from its unregulated business be maintained? If that income is at risk because of the potential of having to refinance debts at higher rates, and that takes a big bite out of the cash flows from that unregulated business, the story could be a little bit different. But I think looking at it right now, I think it's not cheap, but I think it's certainly more fairly valued based on its ability to be a better investment in total wealth creation over the next 10 years versus a treasury.